next one shows on January 1st, 2015, Marshall Company acquired 100% of the outstanding company stock, common stock of Tucker Company. To acquire these shares, Marshall paid to acquire these shares, Marshall issued $200,000 in long-term liabilities and 20,000 shares of common stock, having a par value of $1 per share, but a fair value of $10 per share. Marshall paid $30,000 to accountants, lawyers, and brokers for assistance in the acquisition, and another $12,000 in connection with stock issuance costs. Prior to the transaction, the balance sheets of the companies were listed here. In Marshall's appraisal of Tucker, it deemed that 3 accounts were undervalued on the subsidiaries' books: inventory of $5,000, land of $20,000, and buildings of $30,000. Marshall plans to maintain Tucker's separate legal entity and to operate Tucker as a wholly owned subsidiary, just like what we're doing and the other problem. Determine the amount that Marshall Company will report in its post-acquisition balance sheet. In preparing the post-acquisition balance sheet, any required adjustments to income accounts from the acquisition should be closed to Marshall's retained earnings. Other accounts will also need to be added or adjusted to reflect the journal entries Marshall prepared in recording the acquisition. And then to verify the answers, we're going to prepare a worksheet to consolidate the balance sheet of these 2 companies. So, what we need to do is go back down here and figure out what is the price that Marshall used to acquire the company. Let's create a journal entry, okay? So they issued $200,000 of long-term debt, 20,000 shares with a fair value of $10 a share, which is how much? 200,000. And then $200,000 in long-term liabilities. Okay? So we basically have the consideration transferred. Marshall issued $200,000 in long-term liabilities and 20,000 shares at $10 a share. So how much is that to purchase the company? $400,000. So let's start by saying the consideration was $400,000. What is the fair value of what we're getting? If we look here, we're going to go to the next page and we're going to see we have 20 in cash, receivables are 90, inventory's 140, land is 180, buildings are 220, equipment's 50. So we've got 70, 290, 470, 610. What am I doing wrong? 110, 250, 430, 650, 700, and then we have accounts payable and long-term liabilities of 240. So 700 minus 240 is what? 460? 460. Then it tells us that accounts of inventory was understated by 5,000, so that means 465. See what I'm saying? The land was understated by 20,000. That means we add 20,000, 485, and the building by 30,000. 85, 95, 115, or 515. So we can go here and figure the fair value of everything we're receiving is 515,000. Basically, how I calculated that, I took all the book values, added the difference in the fair values, subtracted the debt we acquired to come up with the difference. Does that make sense? Another way you could do it is just write down all the accounts with the fair values, and you're going to come up with 515. So what happens here, guys, we paid less for it than what we received. What's the issue here? A gain. So we have a gain. Instead of goodwill, this is a gain on a bargain purchase, right? So basically, the acquisition is all getting reported at fair value, but instead of having some type of goodwill, then what we need to do is we need to report the gain on the books. So the initial journal entry, what we'll show here, the initial journal entry is going to be investment in Tucker for $515,000, and then we show a long-term liability of $200,000. The common stock at par is how much was the par value? $1, and how many shares? Okay, so thank you. So the par value here, common stock, is $20,000. What's the additional paid in capital? $180,000. Then we've got a gain on the bargain purchase for how much? 115, was it? So basically, this transaction records the liabilities and stock issued for Tucker acquisition at fair value. Does that make sense so far? Then from there, we need to show the fees we incurred for professional fees and the fees we incurred for any stock. What were the professional fees we incurred? So we incurred $30,000 for professional fees and $12,000 for stock issuance. So we also need to show a journal entry to show legal and professional expense of $30,000, and then cash of $30,000. Then we need to show that $12,000. We don't get to treat it as an expense. It's going to be an additional paid in capital of $12,000 and cash of $12,000. Does that make sense so far? How you doing? the trial balance is going to get adjusted for these changes. So what we're going to do here, we need to take into account, now let's just show the new numbers. Can you guys give me, just so I'm just using the same sheet and I'm just cleaning this up. See what I'm saying? Okay, so what's the company's name? Marshall. And what's the company that they're buying? What? Tucker. Can anyone read to me the cash on that original sheet? I'll show you where. This part. Nope. Here. Marshall and Tucker. Cash 60 and 20, 270 and 90. So I'm going to say 60, 20, 270, 90. Any inventory? What? 360, 140. What else? The investment in Tucker is 400, right? Any other assets? Buildings? 420,000. Tucker? I'm sorry? 220. Anything else? Equipment, 160 and 50. Equipment, 160 and 50. What else? Land is how much? 200, 180. What else? Any other assets? Are we good? We're good. Now we have accounts payable, 150 and 40. Long-term liabilities of 430 and 200. 150, 40, minus 150, minus 40. What else did I say the long-term debt is? What's the common stock? $110 and $120. The additional paid in capital, $360. Retained earnings, does that make sense so far? So, do we balance here? No. 200? Okay, but this side's wrong too. Something's wrong here. Okay. 4 minus 420? I'm missing something. 360, 420, 340. 420, 340. Additional paid in capital is 360. 60, 270, 360, 200, 420, 160. 200, 420, 160. 1,870,000.
$200,000 should be negative.
The land?